Good afternoon, folks. We are looking at the dollar index as our daily chart. As you can see, these are the levels that I gave you first week of January, with the exception of this one drawn out. I did mention that if we did get through this, we would attack the sell side below here. That looks like it may be in the crosshairs going forward. The volume imbalance, as long as we remain below that, all the discount arrays relative equal lows, fair value gap in the order block would be reached, and we have seen that. There's a small little gap in here between this candle's high and this candle's low. I didn't want to annotate that because we already have the fair value gap here. Be mindful of Friday's high. Okay, so the only thing that would change the tune for me on a near term and not see this level where I think 101.30, 101.29 is the next draw on liquidity. If we trade above this fair value gap, not the one that's here, not this one, the one below Wednesday's low and Friday's high, that separation. If we trade above that, come back down and find some support, we would have two areas of imbalance. This one and this one. If we trade down to it like that, that might cause it to find some support and work higher. It looks to me like it still is heavy, but we have not opened up for the new week for trading for Sunday. So it's about a little after 1 o'clock my local time on the east coast of the United States. So we'll look at the hourly chart. You see how we dropped down here, came back up, went back down. This to me is a balanced price range. So it's more likely, in my opinion, to gravitate towards this low than that of going higher. But that can all change on Sunday's opening. It's always, who knows where they're going to open it up. But based on what I'm seeing here on the chart before Sunday's opening on the 15th of January 2023, I think that it's more likely to remain heavy. I'd like to see it gap down, come back up, fill a gap, and work towards this level here. But what I want and what the market gives me is two different things, right? So if we do reverse, and say we get above the imbalance here and the one that I showed on the daily chart, we do have relative equal highs up here for buy side liquidity, and then we have the bearish breaker here. So this down close candle, have that annotated on your chart, draw that out in time. For now, I don't think we need to worry about that. So going ahead, I'm still thinking risk on scenario, which is slightly weaker on the dollar. All right, euro dollar daily chart. Here's the levels we had outlined here and here, and the volume imbalance. So we worked through, took the buy side, and finally pierced the buy side liquidity here. This is the next area of buy side liquidity, and the sell side imbalance, buy side inefficiency, which is a fair value gap here. If we continuously move higher, pay attention to that in here. Okay, it's too clean, small little imbalance, sell side's been offered, so if we go higher, we could see it try to reprice into this imbalance there. Hourly, we have buy side liquidity here. Again, similar vein with what I mentioned on the dollar index. We went up, back down, back and forth, came back down, and showing initial strength. Now, we did go up into this imbalance here. This is a fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. If it trades above it, then this right here should not come back to be retested until these are taken out. And at least between here and here, halfway of that would be enough. So about 109.10, 109.05 for euro dollar. That would be my next objective. Again, barring any kind of reversals here. If we gap down and fill in and start to trade off, we have sell side resting below here. So Sundays are always a 50-50, and I'd just like to see the things I would like to see stay intact on the higher time frame, which would be reaching higher for euro and lower on dollar. E-mini S&P, this is our weekly chart. So we had a nice expansion last week, and I'm drawing your attention to half of this wick. So this is consequent encroachment on a wick, basically halfway point. And be mindful of this level here. Okay, so I don't have the annotation because it would have been too many lines in here. On the downside, let's just say we drop back down and we drift lower. This low of this candle here, which is the high of the fair value gap, represented by these 3 candles. It would need a support price here or half of it, consequent encroachment. I would not want to see it trade back down in. So the last line of defense for bulls, in my opinion, longer term, would be midpoint of this fair value gap on the weekly chart, reaching for an objective of the midpoint of this weekly candle. So this candle here, several weeks ago, we're measuring that wick in half of it. The way you get that level, drop your Fibonacci on this open to high, where the 50% level is. Note that on your chart. Hourly chart on E-mini S&P. Bullish order block. This is the levels I gave you on Twitter. Okay, so I gave you the order block in here and relative equal highs, and we were looking for it to try to trade down into this area, maybe take out the low. We trade back down into this wick, and we've taken buy side. So I want to see it try to expand up into 40.30. That was one of the objectives. We got to 40.20, which is fine, but didn't get 40.30. So I'd like to see a gap up there. Gap up, trade back down, close the gap, and then continue on. That would be the best thing for me technically to expect. But if we gap lower, fill in, and start to sell off a little bit, that would be a little bit concerning for me. This small little gap in here, if we do get a gap lower, you might want to come back and work inside that level there. But it would be better to leave that open, just like this one was. Okay, so that could be a measuring gap. So breakaway gap, measuring gap, sets the stage for around 40.45, 40.40. Buy side liquidity resting above relative equal highs. Here's all of the business. You watch me call all of this CPI out live on a 1 minute chart all morning long. And then on Friday, we had the market drop lower. Here's your low wick there. Split that in half. That's consequent encroachment, which is also half of the fair value gap. Go back through the video and remember where these levels are and where they're anchored to. Half of that point of this to here and half of this wick, that is a discount array. Market trades back up, back into a fair value gap. Then there's how we rolled up, overlapped, rolled up, overlapped back to the previous candle's high here, rolled up, and then left this small little gap here, which it came back later on, overlapped there, and rolled right back up. Small little gap, came back in, back to the order block, rallied up, back down in, rolled up, breaker above it, found support, rallies. Notice it's not just going above the high here. Draw a line from that like support and resistance teaches you. It digs in. What is it digging into? This actual candle right in here. That's your bullish breaker. And then finally gravitating towards the buy side liquidity at 40.20, as I mentioned last week. 5 minute chart on E-mini S&P. Here's that breaker thrown out. The market trades down into the fair value gap and to consequent encroachment of that candle's wick, as I mentioned before, dropping down. Go back through the video a couple times and you'll see what this is because I gave you homework. I'm actually spelling it all out for you here. Short-term high, trade to the consequent encroachment twice, and then breaks higher. This candle here breaks above the short-term high, so there's a shift in market structure with all the reasons why you would expect it to potentially provide that, and it left a fair value gap here. Trades down into it, beautiful redelivery, order block, rallies, all of the back and forth, balancing price action as it goes higher. Buy side here, back down into a fair value gap there. Once more, this is reclaimed. In other words, it's going back into an area. We're cutting through candles because we're not supply and demand. We rally up, order block, find some support, trades through. Look at the candle punching right through it in one pass above the unbreaker. Back down in, support, consolidation, rallies, digs into the buy side liquidity at the 40.20 level and above the old high. And ultimately, on a 5 minute chart, you can see this is the market maker buy model. Consolidation, leave the consolidation, come back in. This is your sell, distribution, shift in market structure. Smart money reversal, low risk buy, imbalance, carry it through, cut through candles, trades back down in, accumulation of longs, rallies, fair value gap, one more buy, secondary buy, consequent encroachment of the gap, midpoint, rallies, order block, finds some support, rallies consolidation, and then runs it right up into near the close of the day on Friday to get to the 40-20 level and clearing the old high for buy-side liquidity. That's what we're looking at going ahead for the week. I'm continuously looking for reasons to allow bullishness on my buy side for index futures, but being aware that obviously we can gap opening on the week and change everything. So we don't trade on Sundays. We prefer to see what the opening is going to be at 9:30 on Mondays. So that way the traders can digest and build their sentiment ideas, build their liquidity pools based on their positions ahead of 9:30 opening. And then we'll see who they punish next. Hope you found this insightful. Until next time, be safe.